This session is brought to you by Zurich Life and Investments. These guys are one of the last true independent life insurers going around, and they're Swiss, so you know their stuff is solid. These guys really understand and believe in the value of advice, which is why they invest in programs like this one and partner with groups like XY Advisor to help drive the positive evolution of financial advice in Australia. Their team are just really good people as well. So if you haven't already connected with them, to learn more, check out their website or speak to your business development contact. This session is also brought to you by Sun Super. They're one of the fastest growing profit for members or industry funds in Australia. They were the very first of these funds to partner with advisors, and they've got functionality where you can actually link to your client's Sun Super accounts and charge advice fees through the fund, as well as a number of tech innovations to make it easier for you to work with your clients. They've got great investments, they're really, really cheap, and their team are just generally legends. So if you haven't already connected with Sun Super, give them a shout because they're doing some really cool stuff.
G'day, Warrick. How's it going, mate?
Good, thanks, Clay.
That's good. Hey, so the best thing about this podcast for me is to catch everyone up to speed. Cryptocurrency is the fact that you are as qualified as it gets in the financial world.
Oh, thanks for that.
Yeah, well, by that I mean.
It's good at talking about.
By that. You're not me.
You're like the Jesus of the financial world.
Yeah, look, we don't have to start off with a low level identity crisis, you know? Which Bitcoin has suffered recently.
Yes, it has, and we'll get to that. But
could you put some context around that grand statement?
Well, what I mean is, here I am trying to espouse the virtues of cryptocurrency, but I don't really know enough, right? And I don't have a history in the finance markets.
It's not what your social media posts say. You position yourself as an expert.
Hey, I know more than most. But certainly, I was introduced to Warrick here recently. And it made me feel a hell of a lot better because all of a sudden I had someone to lean on. So I'd be like, we can with this guy. So, mate, before we get started, can we just please talk about your history in the finance space?
Okay, so I started out in chartered accounting with EYs back in, I'm going to tell you it was in the 70s and 80s, actually. I'll give you an idea how old I am now. Then I went into, I left that and finished my chartered accounting certificate, and I went into stockbroking and financial planning, and I worked with Bain & Company for 17 years, and we got taken over by the Deutsche Bank. And so at that stage, I think that was a midlife crisis I had in the late 30s. That's what my wife at the time said. I'm still having it, she said.
Yeah.
So,
never stops.
No, that's right. So I remember going into, it was Tribeca or one of those names at the time, which was the early days of Kaplan, and I did a couple of test presentations because we'd done a lot of building of our client base through running lectures and financial stuff like that, because we actually had a seminar room in our office.
Oh, nice.
Yeah, so we built our practice that way. And so, I started doing teaching. So I taught with Kaplan from basically 2000 to the GFC. 2009, and I trained 4,000 financial planners.
Wow.
Worked in Malaysia, South Africa. When we went to Joburg, they said, you can't teach a diploma of financial planning in a week. Well, you can if you live in Joburg because you want to get out of there as quickly as possible. And if you wanted to get an Australian
especially
visa.
back then.
Yeah, anytime. So if you wanted, to get an Australian visa, you needed to have a diploma so you could come in. So, I did that till there. Then I had a life coaching business for a couple of years. And then I worked with the mentor group when all the accountants had to get their qualification for a SMSF.
Yep.
So I did that. I went to buy some crypto early last year because I had a lot of students waving the Bitcoin brochure in front of me. And I kept saying, no, that stinks. That doesn't smell too good. And then I could see all of a sudden there was a change happening. So I went to buy some. And before I knew it, I was working in the sector.
Just like that.
Yeah, that's what you do. You go for a job interview when you think you're actually going to buy some crypto. So.
And I can definitely reflect that experience. It's amazing how, because it's such a new space, the moment that you get even quasi involved, there's an absence of knowledge, and
Correct.
so quite quickly people are falling into this. Oh, you know a little bit more than me, therefore you are the expert.
Yeah. Well, our CEO, Nathan Vandenbosch, he's been in the business in crypto for about 4 years, so he's a veteran.
Right. Yeah.
And so, we've seen the increase in storage devices, the CME futures launched in December. What I was saying to Clay earlier, Adrian, is that what we're seeing is like 35 years of financial investment growth, all condensed into about a 5-year period.
Yeah.
So now you're seeing managed funds coming.
Yeah. It's reflective of, I guess, the speed of things these days. I guess.
Yeah. Like almost the Bitcoin graph when you have a look at it, say back from January last year.
The tulip graph, you meant? the Dutch tulip graph.
Yeah, we'll talk
That's
about
what
it.
I like to
Okay.
look,
That means you don't have any crypto, by the way.
Yeah.
Is that how you're working out?
Fist bump. Yeah, exactly.
Yeah, so we'll talk about the polarization.
The smart investor graph, is that what you guys call it?
Correct.
But the graph is representative of the learning curve.
Yeah.
Right? And the
what's
growth.
what's the drop off reflective?
Yeah, well, that's the disappointment of when you know what you know. You know, everyone has that in any education service. You know, you can see I've rehearsed this. I've heard all of that tulip stuff. I've heard of what about the drop? Is that an adjustment or a crash? These are all just subjective words in the English language. Any lawyer knows that.
Yeah. So you're just saying, just got a bit ahead of yourself. It's all
good. Not too good if you bought at $20,000. But currently, I think this morning is $9,700 US or something. So, it was 11,000 only 4 days ago. So
it dropped again.
Well, yeah, but see, that's the viewpoint of the person that doesn't have any. They don't go, the week before it was 9,000, it went to 11. You don't hear this bit. You hear it just drops.
Some great volatility going on here. Day traders must be having a field day.
There's two ends of the scale. First off, because I'm a member of the XY Network Facebook site, and I was saying to Clay, there's this huge polarization. As soon as Muhammad Ali comes out into one corner and goes, crypto's fantastic, in the red corner,
Joe Fraser comes out and
goes, this is the biggest load of shit scam tulip thing I've ever seen, and I will never.
And that's
put my
just
clients
Adrian.
into this.
Bullshit.
Yeah. So we were at the SMSF conference, and like last year in Melbourne, we could hear crickets chirping in the booth. No one was coming around, and it was interesting. Our booth was actually on the end, which was probably representative of the frontier that we were breaking into. So this year we had 160 people visit our booth, and the questions weren't what is Bitcoin? It was more, my clients have bought this stuff in their self-managed fund. How are they breaching the CIS Act?
Yeah.
We can talk about, if you like, those sort of areas.
Definitely.
What's cold storage compared to a hot wallet? And the auditors that were coming up were saying, how do I validate the asset? Where do I get the pricing from at June 30? So these questions were much more sophisticated in terms of either acceptance or guidance in relation to how clients should invest in that
and
space.
hence why, beyond Adrian having a dig at you, why we've brought you on today, because there is a massive that we've had a massive had a massive gap in the knowledge of financial planners. What's original sin? Correct. Yeah, except that should be his birthday, by the way, not 1974. But anyway, yeah, certainly. There is a massive gap. There's a massive gap, and a lot of people are now investing. I think we've all moved on from the idea that this is a scam. And so how do we as financial
said about Bernie Madoff?
How do we as financial planners learn to be able to handle these questions from clients?
Yeah, well, because I've had that education background, we've been working on a project at Bitcoin Trader at the moment, which is basically going to be a training course. We think it'll be either one day, it may branch into 2. So it'll be similar to a certificate that would be registered with Kaplan or one of the major training groups, along the lines of doing a margin lending course or an SMSF course or something like this, because we see that we don't have a problem with advisors giving professional advice from the point of view of saying to a client, look, I don't think this is a very good idea for your portfolio, or I do think it is, but what we want is advisors to come from an informed space. So when I was in accounting and financial planning, I really didn't want to be found out if someone asked me about something I knew nothing about. So my general reaction conservatively was, hey, that's a bad idea.
Yeah.
And often the client, because you've got established trust with them, wouldn't even ask any more questions about that. They just take what you said as gospel, and that's the respect of a professional. But every professional, in my view, needs to undertake some sort of research and not be just closed down immediately on something and say, it's just a tulip bubble or it's this or whatever. I don't have a problem with people getting to that decision if they've based it on some sort of quality research. And number one, people haven't read the Satoshi Nakamoto white paper. It's only 6 pages. No one's read 4 or 5 of the books off Amazon on how cryptocurrency works. They're basically either don't have any themselves, or if their clients, that's the other thing. With a lot of self-managed super funds trustees, they tend to be into that space because they're into control anyway.
Yeah.
And so when that comes, it's a bottom-up push that we're seeing at the moment. So you've got the trustees sitting here of the fund asking the advisor above, hey, should I invest in this space? And the advisor might respond, no, it's a bad idea. So then the trustee goes, well, stuff you, mate, just like water in a stream.
Just go do it anyway.
They go round the rocks and they go and find something anyway.
Well, you end up being not the professional, not the one throat to choke, not the source of knowledge.
Yeah, and most trustees are self-motivated. Otherwise, they wouldn't have a super fund in their own right anyway.
Self-managed.
Self-managed space. So majority anyway. So they find some other way. So one of the problems has been in the Australian market is that when you are onboarding as a client in, say, with Coinbase, CoinSpot, CoinJar, these sort of major groups in the early last 6 months or so, they could only onboard you as an individual.
Yeah.
So if you've got a corporate trustee in your fund, you've opened a wallet account on a crypto exchange now in your own personal name. Mm-hmm. So whether you've got a corporate trustee or you've got more than one trustee, and if you've got an individual fund, you've got 2 trustees anyway because you've got to have an extra person. So immediately there, you've opened an account in your own name, taken money out of the fund and started to buy crypto with that account. Well, that's a breach of, what was that, Clay? I'm not going to swear, but it's a breach of the SIS Act.
It's a little bit like when people were like, oh, it's a super fund and I got my own bank account and I'll just transfer it to this account.
Yeah.
Just because I need the money. Well, and they're 30.
That's right. Well, I remember that in the early days. You get their bank account from an audit perspective and you see the transfer of contributions going in. Then you see Bunnings, Coles New World, the good guys, especially close to Christmas.
You know, like my overdraft account.
And you'd say to them, you can't do that. And they go, oh, but I'm going to put it back in at the end of the year.
Nah.
So what we call that is driving down the crypto highway into the potholes that are virtually unintentional. So some of these breaches have not been intentional, but they do present major problems for both advisors and subsequently the auditors of those funds when they come to not only validate the assets, you know, because they could have put then the money into XYZ ICO or wherever it's gone to. So there's an issue around that, and there's the major issue of the breach of SIS because of ownership. It's basically.
Is that one of the biggest ones that you
I
saw
so.
at the SMSF conference?
Yeah, I think so. So
what about a breach of the investment strategy?
Well, if you go through the process, we've got a 6-step process. So the first thing was, I want to buy some crypto. Okay, let's check the trust deed. Most trustees don't have an exemption against crypto, so that's usually not a problem.
Yep.
But straight away, your investment strategy won't have an asset class that says crypto there.
Correct.
If you haven't got any,
so what would
especially yours.
I open architecture, alternatives.
That's right. Alternative sectors.
Is it classed in alternatives?
Yeah.
You generally just go. Yeah. So if you have a catch-all alternatives clause, that should be
it's fine.
Okay.
So we got an opinion from a PKF specialist partner in this space before we set this up last year. So, and we could see that this issue was happening with the onboarding of the trustees. So let's go back. So we looked at the trustee, that's okay. Then the investment strategy has to be updated. And then when the actual person is onboarded, say through our practice, it actually gets done in the trustee's name. They get a contract note for the purchase of the coins in the trustee's name, whatever that is, corporate, individuals or whatever. So they've got a contract note just as if they were buying shares that way. Secondly, the next issue that comes in, if they're long-term holders, is security of the actual coins themselves. And many people will hold those down inside their mobile phone in what's called a hot wallet, which is
connected to the internet.
Yes. So it's not that safe.
Hackable.
And so hackable, yeah. So there's been exchange hacks. There's been, I'll give you an example of a hack that happens in the hot wallet space. There's a QR code that you can scan with your phone that brings up your wallet address. What some of the hackers have done is got in behind the QR code, you scan it, and you think that's your address coming up. And because it's a 20-digit code, it actually goes to the hacker's address because what you're doing is clipping.
That's crazy. So they're hacking into the QR code scanner.
Yeah.
Wow.
And they've also done that inside Windows clipboard.
So, wow.
when you copy stuff
you copy and paste your wallet address through the clipboard.
Yeah.
not many people are going to check the 20-digit code with X, Y, Z, 2, 3, 4, 5, capital A, B, C, D. But every transaction we do a read back between two people in the office.
Wow.
Yeah, okay.
Because we'd only do $10,000 coin transactions. Not that that's the issue for readback. It's a security thing, but also because it's the consequences of loss of that sort of money in a decentralized network. You can't ring up customer service and ask for it back somehow.
Well, this is like the ones in Japan where there's like millions have just gone MIA. Like
that was the Neo hack.
Yeah.
Well, they actually found that wallet address. And I don't know if you saw the video, but, being Japan, there's a lot of loss of face. So a lot of the directors stood there with their hands like this saying, we'll pay it back. So it was $500 million that was hacked out of the Neo accounts. They know the address it went to, so it got frozen. But so
it can't be able to recover?
You can't release it because whoever's hacked it's got the PIN code of the private hash code to the address on the blockchain. So you can know where it is, but it's a problem.
It's a big problem.
Downside is that when it does get hacked, because it is so secure, you can't get it back.
Yeah. So the idea is that you've got the hot wallets on one side and a device like this, and the alternative, I should have brought one with me today, but it's a USB type device, which is either a Ledger Nano S or a Trezor device. We use Ledger Nano. It's a French company. So when we set those things up for the client, they come in a sealed box. So we don't use any items that have got the broken seal, because we don't know if it's been tampered with or whatever.
Yeah.
So that actually sets up the PIN code for downloading to what we call cold storage. So that plugs into your laptop, and then through a program downloads the private key. Because people go, my coins are in this device. No. Your PIN code, your hashed code, private address is in that.
What happens if you lose the device?
Okay, so when you set the device up, this is a digital age, Adrian, right?
Yep.
A digital age, and then the device actually gives you 24 words that you have to write down, preferably on a piece of paper.
So a bit more than mother's maiden name.
Yeah. So it's 24. It's in American spelling, so humour is O-R, colour is O-R, not O-U-R. So some people make it a spelling error. So you write those 24 words down, and we have a special card we use for that, and we laminate it. Because what happens with our clients if they're holding long term is we take the Ledger Nano device and one copy of the card, and it goes into a vault in Castle Ray Street, underground security.
Right. So once the client has transferred their coins onto this physical device?
No, they've transferred their PIN number.
Sorry?
The coins are up on the blockchain.
Sorry,
and then the 20 words are the backup.
24 words, yeah.
24
words. So if that device gets lost, coffee spilt on it or something like that, you can go back to the internet online site, put in the 24 words, and that will be hashed through the 256 encryption, and that will unlock the code to your account.
And then you can re-add it to a new...
Yeah, you've opened your account.
Do you use the Nano S and the bit of paper in the same wallet?
We have
vault?
multiple copies. So we have one copy... cold storage in the vault, and then we give them two other pieces to put with, somewhere secure. Now, this brings up the issue of estate planning.
Yes.
Because what happens is now, and this is just not in crypto, but you get classical written will, which you still know now has to be on paper, and you've got a testamentary trust built in and all these other things you may have, which is your instruction document to look at the physical assets, which you can then go and find, houses, shares and whatever. However, the digital life that people have these days is something that advisors really need to look at. That's from bank account passcodes, shutting down all your email accounts, getting access to anything that's kept on the digital chain, including crypto.
Yeah, I'd love to go into this a bit more because it's been raised a bit on the XY Advisor Group around, because I guess estate planning professionals maybe a bit more traditional in terms of if they haven't migrated to this digital world, there's a big gap that's around for people's estates.
Yeah, so like when I was in practice, we used a fixed price law service, and there's a number of those in the country that you can look up on the internet and use, and so they will charge normally for a couple about $1,600 for a will with a testamentary trust, power of attorney, letter of wishes, the whole package. So that's great for the documentation side, and they'll take the legal side of that. So, but what happens is that lawyers tend to, and this is just a general commentary, that they tend to be reactive. So you give them instructions and then they put something together, whereas an advisor is proactive. So they're in an ideal space to know the client's balance sheet and their structure, and then elicit from them their family structure as well. So we used to build a mind map on that, and often they'd say, I'm not too keen on my adopted son, so we draw a red line between, say the father or mother into that person. Because when we presented it to the lawyers, they would then come back and say whether there was a family law issue if we tried to exclude that person from the structure. So that puts the advisor in a space that they can be the facilitator, if you like, of the estate plan, but not have to carry the legal weight of the preparation of the documents.
The identifier of the issue.
Yeah, like in Sydney, you can charge $4,000 for that advice, easy, right? And we were getting charged $1,600 from the lawyer, so that's a great profit model for 3 hours.
So you'd absorb the law costs.
Well, you can get it billed directly to the client, and then just charge the excess facilitation, because the facilitation part is the most important. And
that's where you're extracting the information.
Yeah.
Yeah.
And so, because when you're doing estate planning, you've got the logical flow of the money and assets, but you've also got a lot of emotion happening, especially around, you've seen family breakups and things like that, and it brings up a huge amount of emotion. So it's quite a moving experience when you sit with a client and they actually start to talk about their death, and then how they would then. And then sometimes I mention charities or particular children they want to look after for their own personal reasons. It's quite moving. It's actually a lovely part of the practice, in my view.
The context, I guess, that you're alluding to that the advisor has relative to. This is the challenge of specialised services, because they're coming in, they're trying to deliver a great service, but they're dependent on what they can extract from an information standpoint and contextual standpoint in that moment in time.
Yeah.
And this is, I guess, what you're alluding to, that the advisor's in the position to already have that breadth. And then, they pretty much got it. And then, so like what we're doing is actually going, okay, well, what do the estate planners need? We'll extract that information through the journey on our side. And then they're the specialists that deal with all the legal side of things. We just lay out the context of everything.
Yeah, well, one of the things with estate planning and lawyers is you think, there's no limit on the expense. So if you're using a fixed price law service, you know exactly what the cost will be as a quote once you present the information up electronically to their website.
Yep.
And so I can give you the name of a couple of firms after the show if you want to pursue that further. So you load that up, and so they've got that within 72 hours they're sending you down the draft documents.
Yep.
Or they're also sending an email saying there could be family law issues here, there, we need to look at that. One example we had with one case was that they wanted to exclude a particular child under 18 that was from a love relationship when the family principal people had broken up for a 2-year period. This guy had gone off and met this other woman and had a child, and the boy was now 15. Now, his current wife, which he was the one he had before, this is complicated, isn't it, on a Thursday morning. But his current wife came back with him, and they still had other babies and that together after that. And so what happened was that she didn't want to know anything about this other child that he had in the break period, and didn't want to know anything about the mother either. So we have totally briefed the lawyer on this, right? It's really, and so we get 3 pages into the will reading, and the lawyer says, Now, if you, we'll call her Janice. Now, Janice, if you die and Bruce dies as well, your children will need to be looked after by someone. And so we've appointed this other this other woman as the.
So all they saw is all they identified is there's this relationship. They completely missed the context.
They missed the context completely, right? So we've appointed this other woman who, the current wife is probably calling witch number 2.
The Scarlet Letter.
The Scarlet Letter. And so, where's a broom? And so she's when people change colour from the chest up with an open neck, she's got an open neck dress on. You can see the colour rising like this, like this. And I'm there like, oh my God, we're only 3 pages into a 30-page document. How much bad can this be? So as we're going through that, and we got to the end of the document, I said, look, I've got to tell you, I briefed this lawyer and I had no idea she was going to bring this information up. But now that she has, I said, we're going to fix this for you. Oh, how are you going to do that? You mean you're going to kill her for me? No. We're actually going to take out an extra insurance policy on Bruce's estate to cover the inheritance money for the love child. And
Smart.
So what she went, fantastic, because what she saw is the estate was here in that block, and now we're adding some insurance on top that she didn't see was really something that she would have inherited
she's missing
anyway.
Out of.
She's not missing out.
Yep.
It was a great solution, but
Very
it came from a nightmare, page 3.
And it's, I guess,
everyone that's listening to this has had those sort of things with clients.
Oh, my God.
I remember years ago, this woman came in and she was slightly portly, and we had these chairs that had sides on them. Well, she was there for 90 minutes, and when she got up, the chair was stuck to her body.
Oh, bless.
Oh, my God.
Bless.
So as an advisor, you cannot do those number of interviews without having major events and life experiences, what I call spiritual growth experiences as an advisor.
Yeah, they're tumultuous times. Absolutely, when you do suffer through them.
Actually, Clay's got some great ones. Yeah.
We all do.
Our junior days as advisors, they were. Yeah,
we all do. Yeah, there's some horror stories in there, but getting back on track. So as far as crypto is concerned in all of that, where it ends up in the estate is that there needs to be a record.
Correct.
Yes, and so in the will, we need to say here's the location.
Correct.
Of the hard wallet, the cold storage, as well as, and if for whatever reason that isn't found, there is secondary backup
24
code.
word storage, 24 backup,
found in this location.
And I've seen cases already, and well, he knew in this, of that happening, and the clients didn't know that they had it. We found out indirectly that the guy had died.
Right.
And we've contacted the family and said, do you realise there's a wallet in Castle Ray Street in the vault? They're going,
wow.
What wallet?
Yeah, wow. Which is, and potentially there's a lot of money in there.
Yeah, there was $50,000 in coin
which is
there.
a decent amount, right?
So I guess this represents, like, even besides Bitcoin, in terms of you're looking at banking just in general and the way everything's been digitized, all this backup and these innovation techniques around how you have the second factor of authentication,
Correct.
how you have backup. Like, it's really, I find this really interesting because it actually represents the full transition into the digital age.
It is.
And all these innovations on how to, like, to me, that still seems like a shitload of friction in the client experience. So if someone can nail a secure way to
Exactly.
back this stuff up without having vaults, without having, because it's obviously not there because you'd probably use it if it was decent.
Yeah.
Well,
you can do a lot without the cold storage wallet, but the point that we're making is it's not always the safest. And so you can do a lot without all this cold wallet, right? You can keep it online.
Phone.
Yeah. But so it can be frictionless. The result, however, is there's more risk.
What
so
I'm alluding to is that same level of security.
You can't. I don't know.
I reckon there could be some innovation there.
Yeah, I think that's true.
A bit of faith, Clay.
Yeah.
What's coming? There's got to be something coming down.
Yeah, if you think that see, there's a wallet there now, right, with CoinSpot, right, and there's the coins in there,
right? Few little ICOs, is that what they are?
There's no ICOs there, right?
Ethereum.
But there's the total, right? But that was $21,000  4 days ago. So 16,080 at the moment. So it's a $4,000 decline in value in 4 days. Now,
oh, right.
Yeah. Now I'm only showing you that to you so I can back up your tulip theory. But what I'm saying is that if you're going to be sitting with that's only a $21,000 sum I brought in to show you. That's a live wallet. So that's online. So if those guys get hacked or something, that's not on cold storage, right?
Totally.
But it's also able to be traded across a whole range of coins. That's why that particular platform is attractive. But the idea is with that particular thing is that what I'm showing you is the volatility. And not that many people can go out in the surf, crypto surf, if you want to call it that, and handle a 12-foot wave. They can't. So that's important for advisors to talk to clients about.
Well, actually,
is the volatility.
Oh, yeah.
Absolutely. Well, to give you a bit of context on my perspective on it is that the reason I've stayed away is because I'd be, how they opened it up to CFDs and futures markets. I'd be onto those markets with it. So.
Yeah. Well, see, that's like the person that says, I can't go and have 1 2's beer because I'm going to get into bourbon. That's me as well. I'll be on the couch,
Adrian back in the day had a history of trading CFDs
for gold and silver.
Oh, no.
And he made $500,000, as an early 20-something, right?
Yeah.
And then in the same way that he made it, he lost it. And so any sort of talk of anything to do with crypto, he goes, well...
I can see where it's coming from now.
Yeah, exactly.
I'd like to put myself in a box of...
I know.
With buffers and let my risk appetite sort of play out in other directions.
Managed funds. Let's talk about managed funds for a second because... brand new to the market as far as our cryptocurrencies are concerned.
Yeah, so we were talking about volatility on an individual basis, and you've got a certain amount of the herd, and the herd is the general public. It's not a detrimental term.
Herd of turds.
Apologies for that.
Apologies to you herd turds out there.
Clay, look, it's just, I see the herd like, The Walking Dead.
Yes.
There's a couple of people there, you know, and someone says, look, take your motorbike and go down the highway there around the corner and see if there's anyone coming.
Yeah.
And you go down there and there's 10,000 of them all coming up the highway.
$19,000 a Bitcoin. I'm going to buy some more. It's going to go up forever.
This is what it was like before Christmas, you know, the crypto herd. Crypto herd was coming down the highway, you know, and we were going, oh my God, we've got to get these new systems, we've got to do this and that or whatever.
Get the shotgun out.
January's a bit quieter.
Yes.
So, and then double tap if you've seen any crypto movies. So, so what happened is that the volatility is really for the early adopters, the 2% that want to go into exchange and buy and sell and do that. That's not the herd.
Yes.
So the herd will be taken up in the crypto space through managed funds.
Or ETFs, and yes.
ETFs, similar things. So so that means there'll be a portfolio, there might be top 4 or 5 coins in there, and what some of the groups are doing is doing quality research on ICOs to get in on the seed round, which often means that if they're good quality, when they launch on an exchange, they go up 3 or 4 times, no guarantee.
Yeah.
But that's going to add extra performance to the fund.
But it's crazy. I've never gone ICO, right? So I've bought and sold maybe about 10 different ones. The riskiest ones that I've ever gotten involved in, or low market cap, would have probably been something like Enigma, which I guess would be number 50, give or take.
It's got a good name, though.
It's got a great name. Great
branding.
So ICOs is when you sort of get out of that top even 1,000. Right?
Well, I'd say the top. Yeah, I mean, you get there's 1,520 coins as of last week or something, so growing.
Yeah, and so an ICO, for those that don't know, is an initial coin offering, which to me I think is great PR, but a horrible descriptor of what it is. Like, it makes it sound like it's an IPO and you're going to get a share of the company, which you're not.
It's a big dilution of the understanding of IPO.
Absolutely. It's some nerd guy somewhere where, it's like an IPO, but it's with coins. It's an ICO, right? So it's a horrible
There's
coin.
no voting. There's no shares.
Yes.
There's no right to return capital.
There's no value.
There's no potentially in some cases there's no value.
Yep.
So it's so far from an IPO under SEC and American regulations, or say Australian ASIC regulations as a registered company. It's not funny.
Oh, absolutely. But however, so the term at the moment is ICO. Actually, that which goes into a broader conversation, which I think the terminology around this space is horrible. But with these ICOs, these are these new ones, for the people that don't know, playing at home, new coins that are coming to market.
Yeah.
And it is surprising how quickly. In fact, I could a high percentage of times when a coin is listed, it spikes in value.
It does.
Now, I've never, and the reason for that is
listed on an exchange.
An exchange. Mm-hmm. So the reason for that is, my understanding, is that even for the few people that get involved in crypto, and even fewer amount get involved in anything outside of the top 5, and even fewer amount are willing to go onto these individual websites and convert their Ethereum or whatever it is into these pre-released ICOs.
Correct.
Right? So the reason that it's so rare for these people to do it, and I've never even done it, is that a moment that it becomes on an exchange and you don't have to do all these weird sort of things on the back end, that it immediately spikes.
Correct.
And so you've got these managed funds that have got this large, and these are very new to market, these large holdings towards your top 5, a bit in cash, and then a small amount in this higher risk area. I mean, something like that is not... considering a well-diversified portfolio has some alternative assets in there, why wouldn't you have 1% in there or 2%?
That's the argument. It's sort of like a managed fund using hedging with, say, futures SPY contracts, or to hedge against downside risk in the physical market holdings. Or escalation of the performance on the upside using the SPY. You know, you might use 5 to 10% of the fund under your mandate. So that's why it's been taken up that way. And also, if you're a managed fund, you've got fees. So if you don't boost the performance higher than what people could get if they were just buying on an exchange, you're not going to be able to substantiate your management fees to a sophisticated market. And the early money coming in is sophisticated money. It's not the
definitely. Well, I think it's minimum $100,000.
Yeah, $100,000 minimum or something. So those people are obviously got a bit more intelligence around market performance. And as I said, if you've got to say a 2% annual fee on the fund, you've got to do something exceptional.
Well, if you've got this 10% allocation to these ICOs, the size of these...
The performance.
Well, yeah, crazy, right? Because you're getting in at this, 75% discount or whatever on these ICOs.
You have to get that.
Well, in order
it's
to
only
be
on
able
10% of your money.
Yeah,
so
correct.
So add even a 1% performance.
You need to get it
fund.
10 times.
Exactly.
Yeah, which and it.
Hey, you're too bright.
Just being.
That's why you haven't gone into any ICOs.
Don't encourage it.
And you can see from the other listeners out there, they're all too bright as well. That these things, it's like the early days of. I remember back in '92 when I was with Bain and Company, and we launched the Bain Investment Management Service, which was a master trust, and we had double fees because we didn't have the size of the fund at that stage to minimise that with wholesale contracts. Now you do through wrap accounts and platforms and so on. But that was a transition over 20 years. So this will happen over time as that market starts to
it's
grow.
more cost effective for the consumer.
Correct. Yeah, and more liquidity of coins and so on. Yeah.
So the investment philosophy that, like, obviously investment philosophy is very subjective to the advisor or the investor themselves. What sort of philosophies do you see out there? So, like, I don't know, like, you can tell me what your philosophy is around it, but, like, in terms of how do people, because, like, investing, any investing where there's an investor manager and, like, someone's making a call around investments besides an index, and even index, they're all narratives.
Correct.
Yeah. They're all narratives. So, like, what?
Yeah. Well, number one, there's no index. There's no S&P. There's no Dow Jones. There's no index in coins.
No reference point.
There's a reference point on coin market cap, which is really basically a summary of what all the current cap values are. But that's not a function of future profitability or anything. So there isn't any established record like that because we've had such a small time to work with. So if we sat here as portfolio managers and said, what are we going to invest in from a point of view, you could start from a higher level and go, well, okay, we've got an asset allocation up here. This is a new asset sector. What do we think is a reasonable allocation to this particular asset sector, if you want to call it that? Yep. And we don't give advice because we're not licensed presently. We think that will come in the not too distant future as brokers like ours in the crypto space, but that's to come. But we would say to clients, look, if you want to put 100% of your super fund money there, we're not terribly happy about that. That's not advice, it's more an educational point of view. Right down to at the conference at SMSF, we said, look, maybe 10 or 15% is a better allocation. But on an SMSF fund in the market out there at the moment in Australia, the balances are somewhere between $600 and $1 million plus, even on 2-member funds that have been running for some time. So a 10% allocation in relative terms to retiring comfortably by putting 60,000 into crypto or something is not exactly a huge exposure, if you want to put it in those terms. Again, if you're in the Joe Frazier column, what I'm saying is just absolute BS. You wouldn't even put any money there because it just could go to zero, and it could. But it also could go to somewhat higher. But going back to Clay's point, is it worth the performance of 10 or 15% in that sector to add to the overall value of the fund and the interest that someone might have? And I think it's still along those lines that trustees are going, oh, well, I just want to have some exposure to this particular sector.
Yes.
Well, if we take my investment philosophy in terms of, I guess, how I work with clients is a diverse. I love alternatives. I love having something different that doesn't correlate to the share market.
Yes.
So, and it's just to balance out the volatility that comes into play. So I love long short funds.
Yep.
And there's a bit of gold in there. And so
let's talk about this then, because it is surprising considering you do like to plan that alternative assets.
Well, I was leading into it saying that, on that rationale,
just
potentially
steady on, Mohammed. Steady on. What were you saying, Joe?
I said,
very, very good analogy.
I said you got some good skills, Mohammed, and
ducking and weaving.
Yeah, sting like a butterfly.
Sting like a butterfly. Jesus Christ. All right, let's get to the point.
Adrian, you're talking too fast. You've got to talk slower.
And I think we've actually got the same question here because I jumped in on this crypto not understanding it really that well. I simply did it because I believed in the fact that there were going to be more people dumber than me. That was my investment philosophy.
So egotistical, but true.
Yeah, but true, right? So hence why I bought at a really good time and I sold at a really good time.
Do you have to keep saying that? We went down for a coffee before the show, and I think you said it 5 times. And even the girl in the coffee shop was taking notes.
He will not have touched Bitcoin for the next 10 years, and he'll still be referencing how well he did in 2017.
I short black, and she said, that guy's got crypto experience. I wonder if I can get his phone number.
Oh my God. Anyway, but the truth is, I don't really understand the value. And I think to your point, Like, you don't really understand the value. In fact, you definitely don't understand the value. I don't really understand the value. And
this is a great point.
Yeah, and I think this is the best question to ask when it comes to crypto, because I do not know how to value Bitcoin.
Well, there's two levels to this answer, right? The first level is what is value in the first place, and value on the planet is consensus. Value on the planet is consensus. And I hear people go, you shouldn't want to buy crypto because all the people buying crypto want it to go up in price so they can sell it. That sounds like land, housing, shares. Most capital growth asset sectors are based on that assumption, right? Secondly, the value of something on the planet is derived from future earning capacity or its ability to have some sort of intrinsic higher price rise based on the supply and demand graph. So if you've got supply of something increasing and it's, say, oranges, you're generally going to find more orange plants being produced so to meet the supply. So price will tend to top out to some extent in the market. And if there's an oversupply of oranges, it will go down. In the crypto market, if you take specifically Bitcoin, it's got a drip feed supply, 17 million coins so far, and it's going to be another 40, 50 years before the rest get supplied. And you've got a large amount of that 17,000 which is locked up. People have lost their keys. You've got a lot of people holding it long term. You haven't got the herd actually buying any yet, so there isn't even the level of demand we could see when the institutions come with more of their managed funds. Yet you've got this drip feed system of supply. So supply and demand is going to tell you that potentially, this is why some of the analysts like Ronnie Moas and others out of New York are saying that the price could be astronomical. Well, so I started to stutter even as I said that.
Yeah, and as soon as you put that, my mind started ticking over very rapidly. Wouldn't just to get around that issue, that market manipulation, if you want to call it, create a synthetic ETF?
Yeah, potentially. But if in the physical market of the Bitcoin price is going to drive any synthetic on top of that. If you look at futures or whatever, they're always derived from
a derivative. It's derived from
derivative is derived from the derivative expert here on CFDs knows that the derivative is derived from something in the physical world, whether it's an index
if it's synthetic, it's not creating the demand though.
Well, we're yet to see that.
To your point, if once the institutional money comes in,
to give liquidity.
Well, no. So hear me out. So institutions come in, say JP Morgan go, yep, cool, we're going to make an ETF, Bitcoin. They rush in with billions of dollars, right, into the ETF. However,
they can't buy the physical. So there's a limited supply for their demand. So they can't buy the physical.
Well, you're just saying there's not enough sell orders.
There won't be enough sellers.
Well, that's what I'm saying. So if they created a synthetic,
in Bitcoin, there won't be enough supply.
If they created a synthetic,
which is a futures contract.
Yeah. But there's endless supply there.
It's still going to...
They've already created a synthetic.
Yeah, exactly. So that's not going to have an effect on the supply.
No, but there's the current CMF contract doesn't settle in Bitcoin. It settles in fiat. So what they're doing in the UK at the moment is they're looking at launching futures that will actually settle in Bitcoin.
Well, if they do that, then it's going to have an astronomical effect to Bitcoin. But if they just settle in fiat, then it's not going to have...
No, it doesn't have an effect, no.
Yeah, you broaden the liquidity, I guess, of the space.
Correct.
Yeah. So you're broadening the liquidity through a derivative rather than the physicality side. Yeah.
But that because otherwise...
Hang on, just calm down, calm down, Mohammed, calm down.
No, but otherwise a Bitcoin will be $1 million.
It's just... Yeah, it can be because you've got two markets still operating. Just calm down.
He's been waiting to have a whole session of Bitcoin for a while.
I can see it's got sparks coming out the top of his head here. So what's happening is that you've still got the derivative market, like you say, but you're still going to have the physical demand for Bitcoin anyway. So the driving of the price that I explained before between supply and demand is still going to come from people that want to hold the physical. They aren't confident about holding.
No, absolutely.
I reckon the best analogy of what goes on in the dynamics is like the gold market to an extent, and just because of the nature, there's so many, like if you talk to someone about gold and what drives it, and you could get a range of different answers.
Yes, correct.
And the activity that goes on there is the limited nature, and that's also one of the biggest appeal of Bitcoin. There's a limited scarcity.
Scarcity.
Yeah.
Well, it's on fiat, scarcity. Well, if you look at the word scarcity, it's based on
and it's not pronounced scarcity.
Yeah.
That's how we say it in Australia.
No, hang on, you guys are missing a major bloody point.
Sorry, mate.
The word scarcity is exactly scarcity. It's fear. See, scarcity is fear-based lack of resources or lack of supply in any future. It runs through the human psyche. Because if we were running abundance, there wouldn't be any price.
right?
There isn't any price on abundance.
Okay, so basically, going back to your first point, value is on scarcity.
Yeah, so that's at the first level. So if you then drop down into the second level, the biggest problem people have is when we went down for the coffee before the show and I said to you, look, you've had a piccolo and I've had a short black or double espresso or something. How do you put that back in Bitcoin? Because it would have a different price last week at $11,000 US to what it is today at 9,700 when the show's being done. So that's the biggest problem is everyone takes the coin and puts it back into something that has in their mind some sort of intrinsic value, which is their local currency. And that's going to be the case for some period of time. There's going to be an integration of crypto integrated with conventional fiat currency, conventional digital banking, and so on. It's like 4 lanes running at the same time. So these arguments that, crypto is going to replace the whole banking system, no. It's not going to work like that. It'll be integrated into the system, just like when the internet came. It became interneted, interneted, if you like, is a word, but integrated into our everyday life. It didn't replace everything. Yeah, it's an integration. And so this is the way our philosophy in the firm works. We don't go, hey, we're in the Joe Fraser or the Muhammad corner, because that just creates resistance. So as soon as you've got force on something, you'll get resistance. That's just yin and yang with philosophy. So what we're saying is we're more like the water, like the integration of how can crypto be integrated, facilitated into the system like that. So you didn't expect to go down the Zen track this morning, did you, Clay? I can see you've gone to another level of thinking now, mate.
Yeah,
he's curious. He loves just like looking for arbitrage opportunities somewhere.
We spoke about. We won't even get into that.
So just with like the components there, like I think because I think that really unpacking it like that really makes a lot more sense to some people when you go, okay, well, it's a little bit currency, it's a little bit technology,
it's a little bit commodity,
bit commodity because it's scarce.
Yeah.
And like all of these have certain values, but it doesn't. The one thing it's missing is the stability that most currencies deliver.
Yeah, this is in the currency space, but there's 2 parts to Bitcoin that we haven't even examined the other part yet, and that's the blockchain.
Yeah.
So blockchain technology, if you've ever been an accountant or a recorder of books in a ledger, you would write all the transactions down on a page and effectively turn the page over and then write the transactions down on the next page. As you turn the page, that's a block.
Yep.
So in conventional ledger, you can get your whiteout liquid and go back 10 pages and change a transaction. So there's no guarantee of alteration. Whereas in a blockchain, once the pages are turned, if you like, they're locked off encryptively. So therefore, all the records that are recorded in there can never be
So it's brilliant from a security standpoint.
Yeah, and then if you take that concept and expand it in your mind around what the application of that is in terms of a platform to build on, just like the internet was a platform that other people came up with other ideas to build on, that's where there's a large amount of intrinsic value in the creation of the blockchain.
This is where those ICOs, most of them are going, actually. They're new types of technology.
They're sitting on, they might use Ethereum platform to write the ICO app on top of that.
Yeah, which has a different type of function that's not seen.
Which is its own blockchain, essentially.
Yeah, but the problem, as you were saying, Clay, is that if you get one of these tokens and it allows you to play in a gaming site or a property site or whatever it happens to be, the question is, well, why couldn't I just use conventional currency to do that? Why should I use the token?
A lot of this stuff is valueless. But one thing that'd be great to learn about is why the value of blockchain technology. And it's going to take me a little while to even form this sentence. Why the value that's in blockchain technology equals value in a coin. So hear me out. Blockchain technology to me is the internet. Now, I can create companies that are on the internet that create value.
Correct.
But just simply the internet by itself doesn't create value.
No.
So just because the blockchain exists doesn't give value to Bitcoin, in my opinion. Just because we've got this distributed ledgers, on all these nerdy terms, that doesn't, in my opinion, give value to Bitcoin. But what it would give value is to a company that was to use that technology for smart contracts.
Yeah. Now, there is that argument, but I'm going to go back to Bitcoin. An example would be, say we go to Africa and we're in a village there, and I was saying this before to you, you're repairing a bike and I want to pay you in local currency, but I haven't got a bank account I've either got to maybe steal the money or someone else gave it to me in cash and whatever. So our economy is sort of cash fiat currency related to some extent. But we're in this remote village. So we don't have a bank. And even if we had a bank, I don't have an AML KYC process because I haven't got a driver's license and I haven't got a passport and I haven't got any sort of identity as to in fact, I don't even have a birth certificate. I don't even know how old I am.
Right.
But what I can do is I can download cryptocurrency into my phone and I can pick up the bike from the repair shop that you've done and I can transfer to your wallet account. So all of a sudden, outside of the banking system is a totally decentralized growth in money. And this is not a lot different to the way I was saying that those sort of countries that are coming on stream that will come to the end of the industrialized revolution and get up the best of they'll get the best of the information age, they'll get the best of the technology age, and now they'll get the best of the cryptocurrency money type age all in one go. It's like a leapfrog attempt. So an example would be in an African village, to pump water now, you don't have major electricity factories somewhere away that are burning coal or nuclear or whatever. You have solar panels, the solar panels will pump the water up so that people don't have to walk 2 miles down to the river. So they also do have mobile phones because the towers are cheaper to put up than putting wires all around the country, which the Americans and ourselves went through as part of the evolution of information, digital age, and so on.
Well, Kenya, their whole economy almost runs off mobile payments.
Correct. Yeah. So so have a look at it from the value there intrinsically in the what is effectively the unbanked having access to a commercial transaction that can grow an economy, which is decentralized and outside of the banking structure. And we're not saying banks are bad. We're saying that those countries would probably never bloom in a commercial sense through the conventional banking capitalist model. This model is adding value.
If I was to take what you're saying, value then is that the blockchain creates a situation where more, you've just called them the unbanked, but essentially a large portion of the population, the global population, can now enter the financial world.
Correct.
Lower barrier to entry.
And because of that, then demand is increased.
Correct.
And because of that, scarcity is increased.
Correct.
And because of that, the value goes up.
Okay.
Now, it may be that Bitcoin's not the final currency that emerges, right?
Exactly.
There may be...
Because they're so substitutable.
Yeah, but what happened was Bitcoin set the tone in 2009, but then the brains in the world looked at that concept and went, wow, there's a whole new direction. It's like in the Terminator movie where the guy was using the chip that was in the robot's arm to go down a whole new track of technology. So that's really what the technology change in 2009 did. It actually used mathematics to restore trust through the blockchain concept, right at the time when trust was lost in the world through the GFC. It was very timely.
That's a really articulate way of
So
putting
is
it.
it like going to be a combination of brand faith and superior security technology?
And use.
Will
And
end
use.
up... Well, use will be there irrespective.
Yeah, it will.
So you assume that's going to be there because I think that's very sound in terms of what you're saying of that expansion of the market of people operating in the financial system.
Yeah.
But all this, if you look at all the technology... there's a lot of them that are very similar. So really...
That'll be cleaned out.
At the moment, Bitcoin's got the brand, it's got the staying power because it's been there longer.
Yeah, it's 40% of the capital market.
Yep. So
Which has drastically declined, I will say, over the last almost 10 years.
Yeah, it has. But it has to because you can't maintain a premier monopoly position like that in any market.
Totally.
That's basic economics 101 sort of thing.
Good point,
So
good point.
you want it to dilute to some extent because you want the other technologies to come through that may have more value added.
Yep.
So that's a competitive market process.
So it turns the currency concept. So you start to get towards what is used as a currency and you're getting the same benefits there and the stability potentially. And they're maybe making a fee because they have superior technology.
Who's making a fee?
The Bitcoin operator.
Well, the Bitcoin operator is that's another area to discuss, but that's the mining companies that are mostly based in either Asia or there's a lot of factories, when we call them factories, they're actually just sheds of ASIC mining equipment that are doing the algorithms for Bitcoin calculation. But they're up in Iceland because they burn so much electricity. So they're using geothermal power. They're in an environment where there's only 4 degrees, so they open the windows and the cool air comes in. And if you see one of these videos, I'll show you after the show, the guy goes in there's 25,000 machines in a shed. Wow. And there's 10 sheds across the landscape. It's the modern bank because they're all getting a clip of every transaction that's done. Plus, if they solve a block, they currently get 12.5 bitcoins, which is $125,000 or so. So there's
the profit margins at the moment with that?
They're quite high because if you've got low power, but there's more power in the world being used by Bitcoin mining at the moment. I think it was calculated than the total of Nigeria. Now Nigeria doesn't lose a huge lot of power.
Still so over 100 million people.
Yeah, but it's subjective. That's a very green argument. I'm not saying it's wrong, but what you should go and have a look at the power that's used. In
LA,
or the lights that people leave on in their buildings every night. Or whatever. Totally. There's a whole range of ways that power may not be used in the most efficient way. But certainly, this is why there's been arguments for coins to come out, which is
less mining.
There's
some sort of other limiting function.
They have proof of stake, whether instead of proof of the other system,
proof
Bitcoin,
of
proof of work that Bitcoin uses, and that's a whole other argument as to whether there's inflation created off the back.
Could you just have just one that just drip feeds coin, and that's part of it, and no one has to mine it?
Well, a lot of coins these days
doesn't work
just
like that.
Exist.
Because it's got to be dripped from somewhere, and then if it's dripped from somewhere, that gets it back to centralisation. Where's it dripping from? There's one central waterfall, one central source. Where's it dripping from?
Can we have a simpler calculation?
Now you're entering into the philosophy of cryptocurrencies, because there's a lot now that just they don't drip from anywhere; they just exist.
Yeah, like Ripple is
Ripple.
Ripple is a coin that has value because it can be used to transfer money quicker than the SWIFT system in banking. So,
well, see, here's the issue. That gives money to Ripple Labs, the company that owns XRP.
It's a private company.
Yeah, but there's no value there for XRP holders.
No, there is a bit of a problem there. We've got to be careful what we say about that. But certainly they have 5 business arms that they're using with the major banks, one of which is their rapid service. And in the rapid service, as I understand it, is say you're in New York and I'm in, say, Sydney, what you've got to do is transfer your New York dollars, American dollars, into Ripple currency, send it down the line in 3.5 seconds to me, and then I can transfer it back into Australian dollars off the sale through the crypto network, and I've got my money within 3.5 seconds. And the argument that people use is under the current system of SWIFT, it would take 3 days, so you might as well, if you could, put it in a suitcase and fly down and put it into my bank account that way because it's so slow. So, but there's a whole range of argument around
where the value lies.
The value in Ripple, whether it's
is
substantive,
it in the company, Ripple Labs, or is it in the token?
Yeah, let's not go. That is a
sure. We're really delving there.
We can have a coffee shop conversation.
Is
there
anything that's delving into, like, if you think about like the biggest issue around the financial crisis was around the trust between institutions and the banks and the lending and the over-the-counter exposures, and arguably, like, if you look into how much derivative exposure there is, like, it's like 700 trillion in the global. It's probably more now. That was like when I actually looked at that stuff, but it's huge. So this exposure creates this whole sort of ecosystem of dependencies.
Yeah,
and the trust and that goes into that was proven quite fragile in the financial crisis. Now, is there anything that's coming into play around, even like just over-the-counter sort of agreements around derivatives and things like that that's still going?
Yeah, okay. So let's have a look at that. So there was the pack of cards fell over in 2008, 2009, and a lot of us as an advice space lost confidence, because over an 18-month period we were saying to clients, say, for instance, that had 60% exposure in an account-based pension, we were saying stay in, stay in, stay in, stay in. Then March 2009 came. It was like, maybe all my training is shot to pieces here, and I should have told them to sell back to cash 6 months ago, 8 months ago. You started to lose your belief in diversification theory,
modern portfolio theory.
But that was just when things started to turn around. But that was a lesson for the planet around how much trust we placed in that particular system. And it was a perturbation, if you like. It was a boiling point. And so what happened out of that was we had to fall back to something, and what we fell back to was financial mathematics. And so the encryption process in a blockchain is basically trust created by, I know you, or you can't hack my account over there because it's locked off through mathematics. And so now I've got some restored trust. So it was like a platform built. But you can't run the planet on mathematical trust. We're not robots. So we have to still restore the trust triangle back, but now it's
got support.
It's coupled with mathematical basis. If you look at it this way, that's pretty deep. But
because like the thing is, like this it doesn't get talked about that much in mainstream media, but this whole sort of derivatives exposure and essentially mythical market, essentially what Clay was referring to before, that's been done on the whole financial system, essentially.
Oh yeah. That's no secret.
It's just hanging there as a potential, systematic risk.
Well,
is there something?
Well, net, it doesn't exist. Like
we won't go just there. So I know your name's Mohammed, so I understand.
What I'm angling for is there like a channel where there's more support that could be mitigating that systematic risk?
I didn't expect to talk about this, but if you go back and look at, say, debt markets versus quality stock markets originally, debt markets were based on an interest component, a set period of time, a promise of refund of capital, all of those components on that side. True? That's a debt security.
Yeah.
Yes.
If you go to the stock market, there's no promise of return on capital, there's no promise of profit, there's no actual time limit because a company as a going concern is infinity on
Correct.
that side. So those two models existed in the yin and yang space together for a long period of time. The problem was for the GFC was that someone started to take this side and take it over to this side to escalate the returns on the share market side.
That's cool. That's a very good understanding.
That's what happens when you train 4,000 financial planners. So that if you see that happening, and then derivatives started to grow out of the weeds, and there's an infinity sign at the top of that side of the yin and yang, right above the stock market side.
But you keep the same label on top of that.
But this side has still got its intrinsic issues of repayment and promise and so on, and so you get to the stage where
the worst of both worlds in one.
The best of both worlds, Adrian.
Sorry, for a limited period of time until the tulip bubble bursts.
So if you can see that in your mind, you can see where the problem came from in the GFC. It was a mixing of two things which should have been kept separate. See, when you bought shares in the 1950s or whatever, you couldn't borrow. There was no margin lending accounts. There was, there's just no debt that you could do. You had to go in and take your savings and buy shares or those sort of securities.
So do you think even if you introduced this support of the mathematical security that can be applied between, and they all had accountability between themselves, the fact that the debts and the leverage is still there, it's not going to fix that.
No, but there's a loss of trust in the world now. There's fake news. There's non-belief of the kings running certain parts of the world in terms of their behaviour and so on. And so that's a challenge for advisors out there, because if you sit in front of a client, you're being tested, if you like, from minute to minute on your own belief in your trust of your own ability as a professional. So you can only vibrate trust across to a client if you believe in yourself. And we used to talk about this with young recruits, that if they had to take on an identity, and people say, I just need sales training. It's like, no, we didn't call it sales. We called it influencing with integrity. But the fact is that if you take a Macquarie Street surgeon and they've had sort of 5 years of standing beside someone else that's been cutting into someone's body and doing heart surgery, they take on the identity. That's how mentoring works. It's a vibration. So as an advisor out there, especially XY advisors that are younger, the best thing you can do is work with your colleagues and other mentors to take on the vibration of professionalism, because at the end of the day, your work is based on your quality vibration in your own belief of who you are as a professional. And that's not ego. It's a spiritual experience. Sure. You cannot sit as an advisor after 3 or 4 or 5 years and be the same person you were 5 years ago. There's no way. Anyone that is listening out there, including you guys, know you've changed.
Absolutely.
You get challenged. It's like you go into that job and you're sitting behind a desk or with clients being put into a position of trust. And that trust is often like an Everest backpack. I did it in the 80s. I carried the Everest backpack of clients' responsibility of a $150 million portfolio, which in the 1980s was a lot of money, or retirement
Still a
money.
lot of money now.
But that was retirement money. So when the market crash came in 87, it was very, very challenging because I felt personally responsible, but I was responsible for something I had absolutely no personal control over, but I still felt it.
Well, it's the expectation management that we take on as professionals.
We do.
We weren't able to, if we can't manage those expectations.
No, well, not everyone can do this job, and I think everyone needs to appreciate that's listening as an advisor, that you are in a privileged position of gratitude to have clients place their trust in you, but they should also be in gratitude for you looking after them as well. So that's a whole model of advisor that changes the space. The equal sign is different now. The advisors used to be high on one side and clients low. and that created a litigation gap potentially between blame and you've done the wrong thing by me, blah, blah, blah. The modern model for your listening audience
That's like the blame model.
Yeah, the blame model. And the bigger the gap, the bigger litigation risk. Yeah. So if you move that model up into a balanced position where the advisor comes off their pedestal,
which is much more buy-in from the client.
Yeah, and you've got shared responsibility. You won't get sued. You won't say, oh, yeah, well, that couldn't happen. You're less likelihood of having litigation, but you'll have a much better relationship with your clients on that basis of, and that involves education on the client's position and also involves them taking some level of responsibility for the joint decisions that you make together.
We're definitely getting Rick to the course, eh? Absolutely. Yeah. I'm going to be hassling you to do it.
What Adrian's alluding to is we've got this new online training portal that's coming out very shortly. We've got some top minds from financial advice in Australia creating short courses.
Excellent.
So if that's something you're interested in, we can chat about it later.
Yeah, I've got education ethic because I just went into that mode totally.
Yeah.
No, mate, that was brilliant. That was really cool.
That would be great.
And this is my point. And like I started with this. Like you've eminently qualified in this space, and you know your shit when it comes to crypto. So you're hugely valuable. I think to ignore crypto at this stage is insane. If two things aren't going away, one, money, two, internet.
Yes.
If those two things aren't going away, then internet money is definitely sticking around. And if we're financial advisors and we deal with money, if we're sticking our heads in the sand in regards to this, we're doing a disservice. Yeah. I'm not saying invest your clients. What I'm saying is get your head around this.
Yeah, well, we're actually having a symposium in May. There's just a short plug, which is going to have 7 speakers on super, tax, the Australian Digital Commerce Association, blockchain, like the whole ambit of that space. No one's done anything like that before. We're holding it at the Four Seasons in Sydney. And the reason I chose that venue is because it's got a 12-metre 4K screen in there. It's brilliant. Absolutely. I saw that and went, where do we sign?
So you can see all the hot wallets up there.
Yeah, they
really
can see everything.
Yeah.
They'll show the blockchain up on the wall. And
how do people get tickets to this?
We've just finished our landing page, which will launch next week. So they can contact us and they'll go on the list. But the landing page with Eventbrite tickets and that will be launched next week. It's on the 10th of May.
Well, this podcast will probably come after that. So what's the URL that people can go to?
It's called Decrypted.
Decrypted?
Yeah. I'm just not sure whether I've got 2018 or not behind that yet. So I think it's decrypted.com we're using at the present time.
Okay.
And I don't want to get too into advertising. I didn't come here.
No. We're sort of getting to that point anyway.
Learn more, where would they?
Well, what's the name of the company? Actually, this is
Bitcoin Trader is our business.
Yep.
And the problem is that a Bitcoin Trader has been used by some bot scam people in the United States, and that's given us a bit of flack because our URL is bitcointrader.org.au. Which is an Australian corporation, totally unrelated.
Yeah.
And there was a show on Shark Tank talking about a $250 turning into $750 bot run by this group in America called Bitcoin Trader. My God, did that make the phone ring at our office.
Oh, my God.
So, every TAB betting guy with his singlet and stubby shorts on and thongs is ringing with his $250.
Well, this just happened to me a few weeks, this last week.
No.
Shocking.
Oh, no. I can just imagine.
We should put a recorded message on that line saying we're unaffiliated.
Yeah.
But one of the guys in our office, you can see his face. Oh, not another one of those calls.
Yeah.
So and then just to wrap it up. So what do you guys do?
Well, we basically deal in the top 5 coins. We deal in Bitcoin and Bitcoin Cash and Ripple, Dash and Ethereum. And we only deal in $10,000 sums per coin. And so we've got a specialised superannuation service. We've got a deal with Express Super and some other firms that refer clients onto us. We don't market to the general public. So our marketing is to financial advisory firms, to the trusted platform, as I call it, to accountants, financial planners, those people, because they've already got the experience in that space.
So even if an advisor doesn't want to recommend, but their clients are saying to them, I want to.
Yeah, they forward us to us. And that last thing is about APL lists. You crypto's not on an APL list, but so you've got to be careful about that sort of thing. But you can refer clients on just as you would in the real estate market. You can't talk about buy number 7 William Street, but you can say, go and talk to this property specialist, and they
We've identified this risk. We note it down.
Yeah, you've noted it in the file
you
notes and so on.
You need to talk to a professional. These guys are professionals.
Yeah, so like that.
Awesome.
And so that's our specialisation. There are other platforms that deal in the general public, but that's not our niche.
Sure. And then you're also on LinkedIn, I know. Is there Twitter or anything else that you're on?
Yeah, we've got, we haven't gone down the Facebook, Twitter because of the fact that we're more boutique.
Yeah.
Because Facebook now, crypto ads are banned on Facebook anyway, which I think is a good thing because there was a lot of rubbish on there.
Yep.
So we've got more of, we're at the SMSF conference. We're on IFA magazine. We've got an in-house journalist that's writing articles all the time. We're the only ones in Australia that people are coming to get information like this podcast or some of the articles that we've written you'll see pop up in SMSF Advisor magazine, or we've got a spread in IFA magazine coming up next month and that sort of thing. So so that's our niche space.
Awesome, mate. Yeah. And I believe that you wanted to read out just a disclaimer at the end, just to say that it's education and not
you wanted me
advice.
to read it? Okay, well I wasn't expecting that. So
also
let
because of my
it
investment philosophy that I spread out there. It's just general advice.
Absolutely.
You need to consider your own personal situation with a financial advisor.
Because even though this is a financial advisor podcast, there's nothing to stop the general public from listening to it. So that kind of thing we need to. And if not, we can.
Pretty much just go see a professional. Nothing that's been said in this podcast.
Yeah. Oh no, I'm going to read it now because I have.
Can you do it in your best radio voice as well?
Well, I was going to say he has a voice for radio. Like
Well, I
wouldn't mind getting Rick in just as a cameo, interviewer position
weekly.
So then I can listen to someone that sounds way better than us.
I told you my future career is as a love god.
Richard Mercer.
Yeah, Richard Mercer. Look out, Richard! Here I come. So yes, Debbie. Bruce really loves you, and I really feel this.
He doesn't have any bitcoins. He's telling lies.
And this track from Neil Diamond is really going to open you up heart-wise this evening, and I know things will restore in your relationship. Thank you for the call. Okay, back to this. So you haven't had a guest like me on before, have you?
We should have
never
more.
again.
Yeah,
never again.
Welcome back.
Yeah, that's right. Okay, so the disclaimer is that the content and commentary in this podcast is for informational purposes only and does not constitute investment or financial advice. Any information, material or commentary is intended to provide general information only. Information contained in this podcast has been obtained from sources believed to be reliable, but BT Brokerage Services, trading as Bitcoin Trader, and its representatives makes no representation as to its accuracy and completeness. And before acting on any information contained in this podcast, each person should consider its appropriateness having regard to its own or their own legal, client responsibilities and financial situation and needs. It should obtain independent taxation, financial, legal advice accordingly. And this disclaimer also applies to the Muhammad Ali and Joe Fraser sitting next to me as well. And thank you. And
the
night.
compliance department erupts in exuberant joy.
Mate, I've got to say, this has been a super informative, super valuable. I really appreciate your time coming in. I think it's great to touch base with you. I'm so glad to see that someone in the industry has taken a leadership in this area. And, I hope our audience really appreciates also your insights. So
It's been great.
Thank you very much, guys. Thank you.
Cheers, mate. Thank you.